Hello and welcome to the third part of this little series about monetary policy. Today we finally talk about unconventional monetary policy. In particular, we will talk about a measure that is arguably the most extensive intervention of central banks into our financial system for at least 4 or 5 decades. The topic of today's video will be quantitative easing, or QE. Everyone who is interested in our financial system has come across this term in recent years, I'm pretty sure. Many of the major central banks have conducted or are still conducting quantitative easing. For instance, the Fed, the European Central Bank, the Bank of Japan, or also the Bank of England. In fact, the Federal Reserve and the ECB just recently have increased their QE programs due to the coronavirus. But what exactly is QE and how does it work? And why did the European Central Bank, which is, as you know, the focus of this video series, why did the ECB start QE in the first place? We're going to start with a figure you already know from previous videos. It shows the interest rate corridor of the ECB. I have talked a lot about this already. So let me just focus again on this point here. We have three different interest rates here: the marginal lending facility rate, the main refinancing rate, and the deposit facility rate. These form the interest rate corridor. It's the rate here on the top for which banks can borrow from the ECB overnight. Here at the bottom, it's the rate for which banks can deposit funds at the ECB overnight, and the main refinancing rate in the middle of the corridor is the rate for which banks can borrow for 1 week from the central bank. And as you have seen, starting in around 2012 and then in 2014, these rates have reached the zero lower bound. And in particular, after this main refinancing rate has reached the zero lower bound, conventional monetary policy, which means the change of interest rates, was restricted because the ECB was and is still not willing to lower this main refinancing rate below 0%. So this classical transmission mechanism, which I have shown you here, which is called the bank lending channel, this mechanism was broken because down here we have reached 0%. And so there was no room for further interest rate decreases. So there was a need for an alternative measure to bring back inflation to close to 2%. And one of the main unconventional measures that was used in order to do that was quantitative easing. And in order to understand the motivation behind QE, it is important to know that the central bank does only control very short-term interest rates. So if you take a look at this, the maturity of the main refinancing operations is only 1 week. So banks can borrow from the central bank at a 1 week maturity. So all these interest rates I have shown you here are either overnight interest rates or at most 1 week interest rates. The interest rates that actually count or that are important for the real economy to have a way longer maturity than only 1 week. And these are exactly the rates that then firms or private companies have to pay to banks. So what banks are doing is they borrow money from the central bank, and then they, based on this money, they create loans to the private economy. And you see here that the maturity on their financing side is 1 week, but the maturity here on the asset side of banks is several years. And this is what's called a maturity mismatch, or what banks are doing is a maturity transformation. That's one of the main reasons why bank exists, actually, in order to do this. But this also means that the central bank cannot directly affect these major longer-term interest rates. So we also see this quite nicely here. What you see here is a so-called term structure, or the term structure of yield curve. So these are yield curves of AAA rated government bonds in the euro area. We have on the y-axis the yield of these bonds, and on the x-axis we have the maturity or the residual maturity of these bonds. So each curve shows for one point in time the yields for AAA government bonds for different maturities up to 30 years. So let me give you an example. The blue curve is the yield curve at on the 28th of February 2006. So on this day, all the outstanding AAA rated government bonds had the following yields. So a very short-term bond, say a 1-year bond, had a yield of somewhere between 2.5 and 3%, while a 25 or 30-year bond had a yield on this day, on the 28th of February, of, let's say, 3.7, 3.8%. Now, if we move forward 7 years to the 28th of February 2013, we see that this yield curve changed. So on this day, the short-term bond, the 1-year bond, had a yield of roughly 0%. So almost 0%, while these longer-term bonds still had a yield of more than 2.5%. And here you see very nicely the impact of the central bank. So the central bank was able to massively decrease these short-term interest rates because it's able to steer the very short-term interest rates directly. And of course, a 1-week interest rate is related closer to a 1-month or 1-year interest rate than to a 25 or 30-year interest rate. So the ECB was very successful in lowering these short-term rates, but it was not so successful in lowering these longer-term rates. And now the problem is, of course, that, and you can see this here as well, the short-term yields, short-term rates have reached the lower bound. So what can we do in order to further revive the economy or have a positive impact on the economy and conduct expansionary monetary policy? Well, what we can do is we can try to impact long-term yields more directly. And as I've said, these are anyway the more important yields because these are the interest rates that have to be paid on these longer-term loans that are used for investing. So how can we impact long-term yields? Well, we can do that as a central bank by purchasing these government bonds. And as the ECB purchases a lot of these bonds, the price will increase, and this means the yields will decrease. So recall that there is an inverse relationship between the price of a government bond and its yield. So that's exactly what the ECB started doing in March 2015. They started purchasing euro area government bonds. So in the euro area, this is called the Public Sector Purchase Program. What you see here is an overview of what's called in the euro area the asset purchase program. So this does not only include the purchase of government bonds, but also the purchase of corporate bonds, of asset-backed security, and so on. But as you can see here in blue, most of the volume has been purchased or has been invested into government bonds. So the y-axis shows the volume. These are the monthly purchases of this program. In blue, you see we started in March 2015, and the first announcement was that the ECB planned to purchase 60 billion euro of government bonds each month, starting in March 2015, ending in September 2016. As you can see, the program was extended several times, so we did not end in September 2016, but we actually ended in December 2018. However, what you can also see here is that the ECB restarted this program in November 2019, and as I have mentioned before, in March 2020 they have now even increased their monthly purchasing volume. So we are back in QE mode. What you can also see here is a breakdown of the cumulative purchases, so adding up all the purchases that have been done over time. And as of end of February 2020, the stock of bonds that has been purchased in the whole APP amounts to 2.7 trillion euro. And as you can see here, most of it, so here we are at 2.7 trillion. And as you can see, most of it, so clearly more than 2 trillion, has been allocated to the public sector purchase program. So these are massive amounts. The ECB holds more than a quarter of the outstanding government bonds in the euro area. So one important question is, of course, given that this was such a massive program, was QE successful in bringing down long-term interest rates? So let's go back to our yield curves and look actually beyond 2013, and let's take a look at how this yield curve developed. So we can see here now our old yield curves here in green, now a dark green, February 2006. We have the old yield curve in pink or purple or whatever that color is in end of February 2013. And now we take a look on the effect of QE, which is first February 2015. This was actually slightly before the actual start of the program, but the program has already been announced in January 2015. So there was already the announcement effect was already in these yields. And then finally a very recent yield curve of February 2020. And what you can see that yields have decreased massively. In particular, long-term yields have decreased. So we have been here already at the zero lower bound, and you see even though also short-term yields have decreased, there is not that much room here on the short end of the yield curve. But we have quite extensive decrease in yields here at the longer end of the yield curve. And as you can see, what happens is when you only decrease slightly here, but massive decreases at the long end, is a flattening of the yield curve. So the slope of the yield curve decreases, it gets flatter. Of course, it's important to note that QE was not the only driver of decreasing rates, but several studies are out there that suggest that QE had an impact on these long-term yields. Now, before we take a closer look at how QE works, let's talk about why it works. In other words, why do large-scale government bond purchases push down the yields of these securities? This question is more difficult to answer than it seems at first. So in particular, that's maybe a nice anecdote, in particular at the time when these policies have been implemented, the Fed was even earlier than the ECB, it was not clear, and honestly it's still not fully clear, how and why QE works. So in 2014, Ben Bernanke said at a discussion at the Brookings Institution, I quote, "The problem with quantitative easing is that it works in practice, but it doesn't work in theory." So we see that it works, or at least it looks like it works, but we do not really understand on a theoretical basis why it works. In general, there are two main transmission channels of QE. It's first the signaling channel, and secondly the portfolio rebalancing channel. And both of these channels try to explain theoretically why large-scale asset purchases of government bonds push down the yields of these bonds. The main idea is that QE affects two primary factors that determine the yields of bonds. And you see this here in the middle, I have plotted them. So imagine this whole bar is the yield of a government bond, and you can dissect this yield into two components. The first component are the expectations about future short-term interest rates. And the second component is the so-called term premium. And then we have our two channels, the signaling channel and the portfolio rebalancing channel. And the signaling channel affects this lower part here, the expected future short-term yields. The idea is the following. So as you can see in the equation here on the right-hand side, the long-term yield, which is here on the left-hand side, is the product of future expected short-term yields. So let me tell you what I mean by this. This 1 plus I to the power of n here, let's say n is for instance 10 years, has to equal the product of the yield in the first year. So this is a 10-year yield here on the left-hand side, and this has to equal the product of the yield in the first year. That's a 1-year yield. Then the yield in the second year. It's a 1-year yield as well, and so on up to the yield in the 10th year. So this has to be true according to the expectations hypothesis. So this also means if I expect the future short-term yields, so the 1-year yield in year 2 and the 1-year yield in year 3 and the 1-year yield in year 10, if I expect these rates to be low, this also means that my long-term yield here on the left-hand side should be low. And by purchasing many of these government bonds, the ECB signals, and this is where the name comes from, the ECB signals that it will keep these short-term rates, which it can impact directly. We have seen that, right? The ECB can impact short-term rates. And it's an implicit promise by purchasing all these bonds. The ECB signals that it will keep these short-term rates low for long, because otherwise the portfolio of the central bank will suffer a big loss. Because recall, when yields increase, prices decrease. So the central bank has an interest to keep these yields low in order to avoid losses of its bond portfolio. So that's the so-called signaling channel, which leads to a decrease in yields. And then the second is the portfolio rebalancing channel, and this one affects the so-called term premium. The term premium is the compensation investors require for holding a long-term bond compared to rolling over a series of short-term bonds. So in order to understand this, we can go back to our equation down here. So you can either invest into a long-term bond here. This would be the left-hand side here, or you can purchase short-term bonds. So you can first purchase this 1-year bond, and then in the next year you purchase another 1-year bond, and then in the third year you purchase another 1-year bond. So this is the same as purchasing a 10-year bond. And the term premium describes the compensation you require for holding this longer-term bond. So according to the portfolio rebalancing channel, large-scale government bond purchases can lower this term premium. In order for this channel to work, however, you need an imperfect substitutability of short and long-term government bonds, because only in this case, purchasing long-term bonds lower the term premium of these bonds. So this is a bit more involved than the signaling channel. I won't go into a lot of detail here. The intuition is just that you can only impact the price of long-term bonds if you have this imperfect substitutability between long-term and short-term bonds. So there are other channels, of course, besides this portfolio rebalancing and signaling channel. For instance, there's also an exchange rate channel, but I will not go into detail here on this. The bottom line here is that QE is able to lower long-term interest rates, and this has a positive effect on the economy, which means it increases investments, consumption, GDP, inflation, and so on. So you might ask, why is this the case? So why do lower long-term interest rates have a positive effect on the economy? And we have learned about this in the last part of this series, this so-called bank lending channel. This is one reason why lower long-term rates have a positive effect, and you can go back and have a look. In particular for QE, there are also other reasons why lower rates have a positive effect. For instance, there is also a wealth effect. So everyone who holds government bonds is richer when the value of these bonds increases, and being richer, of course, allows you to spend more. If you're a bank, it allows you to extend more loans, and so on. So I think now it's time to take a closer look at how QE actually works. So how is it implemented? What are the really the details of the transactions that are going on? And to understand this, we go back to our balance sheet model, which you already know from part 2 of this series. So if you have not seen this model and you're not very used to balance sheets, I recommend to go back to the second part of this series and have a look at the introduction of this small model. So just to give you a quick reminder, we have three sectors in our economy. We have a central bank, we have a banking sector, and we have a non-bank sector. All of them hold government bonds on their asset side here. The non-bank sector holds bank deposits, which is an asset for the non-bank sector and a liability for the banking sector. And very similar, the banking sector holds reserve on its asset side, and this is a liability of the central bank. So now what happens in this economy when the ECB implements QE? QE is also known, and I have used this word several times, it's known as large-scale government bond purchases. And this is exactly what it is. The central bank purchases government bonds on a large scale. So how does it work? You will see that QE is simpler than conventional monetary policy that we have discussed in the last part of this series. It's actually not that spectacular. What happens is that the central bank creates first new reserves because it needs these reserves in order to pay for the government bonds it's about to purchase. Let's first take at the case where the ECB purchases these government bonds from the banking sector. So as you can see here, what happens is the central bank transfers the reserves to the banking sector, and in return it receives the government bonds from the banking sector and now holds it on its asset side. So note that the balance sheet size of the banking sector did not change. Let me jump back and forth. So you see here that the balance sheet size of the banking sector did not change, but the balance sheet size of the central bank has become bigger. So take a look here at the left balance sheet. The central bank extends its balance sheet when it conducts QE. And recall that our conventional monetary policy looked very similar here. There was also this transfer of government bonds, but the important difference was that in case of conventional monetary policy, this was only a secured loan, right? So these government bonds only played the role of collateral, and after 1 week they were automatically transferred back onto the balance sheet of the banking sector. Now in QE, this is a true outright purchase the central bank is conducting here. It purchases these bonds from the banking sector, and now it holds these bonds until maturity on its own balance sheet. Now let's take a look at another very interesting case, namely what happens when the ECB purchases bonds from the non-bank sector instead of the banking sector. So first, the central bank, as before, has to create new reserves in order to pay for these bonds. The problem is now the non-bank sector cannot hold or accept these reserves. And this is why we need the banking sector as an intermediary for this trade. So what is going to happen is the following. The non-bank sector sells its government bonds to the banking sector, and in return it gets new deposits. And the banking sector then sells these government bonds to the ECB and in return receives reserves. So this looks as follows in the end. So here you see it has happened exactly what I've just described. First, the government bonds of the non-bank sector are transferred via the banking sector to the central bank. So these government bonds end up here on the balance sheet of the banking sector. Since the non-bank sector first sells these bonds to the banking sector, we see here that we have additional deposits. And since the banking sector sells these government bonds to the ECB, the banking sector ends up with the additional reserves. So this final picture of our economy also allows us to clarify some big misunderstandings about QE that are extremely popular in the financial press. So usually what you can read there is that QE creates additional reserves in order to force or incentivize banks to lend these reserves to the real economy. And as you can see here, banks are actually not able to lend reserves to the real economy because non-banks cannot hold these reserves. And additionally, the banking sector receives way more reserves than it needs for creating additional loans. So it's impossible for the banking sector to get rid of these reserves. So recall that the banking sector needs to hold only 1% of reserves in order to back its deposits, right? Or its the loans it has created. So basically the banking sector could create 100 times this amount of reserves it has received here as loans. So this is impossible, of course, and this is also why the banking sector ends up with what is known as excess liquidity. And this will be one topic of our next video. We will talk about some of the unintended consequences of QE. So in the next part of this series, we will come back to these balance sheets again, and we will take a look at things such as excess liquidity. We will take a look at things such as negative interest rates. And again, this little framework here will allow us to understand quite intuitively what is going on, and it will allow us to avoid mistakes such as telling that or claiming that the banking sector is actually lending these reserves, because this is something that is clearly not happening. Okay, let me conclude this session. First, the ECB has introduced QE, which is called the Public Sector Purchase Program, or PSPP, and the reason for doing so was because short-term interest rates had reached the zero lower bound. It started the first round of PSPP in March 2015. This program was extended several times. They started with 60 billion of monthly purchases. This was cranked up to 80 billion and then reduced again later. The end of the first round was in December 2018, and then in November 2019 the ECB started its second round of QE. This is still ongoing today, and actually a couple of days ago, so early March, the ECB increased its purchasing volume again because of the coronavirus. The total purchase volume as of today, as of February 2020, is more than 2 trillion euro of the PSPP program, and more than 2.7 trillion euro if you look at the whole asset purchase program, which also includes the purchases of covered bonds, corporate bonds, and so on. Now, the interesting thing is QE seems to work in practice, but it's not that trivial to argue theoretically why QE works. So we have this portfolio and the signaling channel that aim to explain theoretically why QE might work, but this is still an ongoing discussion in the economic and finance literature. So there are very solid arguments for why QE should actually have no effect at all on asset prices in the economy. One important thing that I wanted to clarify by using our balance sheet model is that QE does not work through banks passing on reserves to non-banks. So it's not the case that the central bank hands over reserves to non-banks and hands over reserves to banks and expects these banks to pass on the reserves to lend the reserves to the non-bank sector. This is impossible, and this is also not what is happening, and this was never the intention of QE, neither in the euro area nor in the US or anywhere else in the world. So this is it for the first lecture about QE. As I've said, we will take a look into the unintended consequences of this program in the next lecture series. And of course, as always, if you have questions, feel free to post them under this video, and then maybe I'm gonna make a Q&A session at a certain point in time and try to answer as many of your questions as possible. Okay, thanks for watching. See you in the next video. Bye bye.